Welcome back to the video for chapter 14. We're going to continue on talking a little bit more detail about distillers' grains. And so these are that byproduct of the dry grind ethanol production process we talked about briefly before. And the stuff is valuable as a livestock feed because it's about 26% protein, 18% fat, and it also has a pretty significant amount of straight calories that come from a little bit of carbohydrate. So it can be used to replace both energy, which is typically provided by corn in a more traditional livestock feed ration, and it can replace protein as well, which would usually be accomplished by feeding soybean meal. So if you're going to use DDGs, you get to use a little bit less corn and soybean meal in your livestock feed. So next here we have in figure 3 a price chart for DDG prices and corn prices. And just a casual inspection reveals that these things tend to move together a little bit, maybe not one for one, but their general trends are usually going in the same direction. If we look at this slightly differently in figure 4, I've plotted the DDG to corn price ratio. And you can see it varies a little bit, but typically the price of DDGs is around 0.4 and usually is within a range between 0.3 and 0.5 of the corn price. So let's talk briefly about just ethanol prices. And since ethanol is blended into the transportation liquid motor fuel supply, it makes sense that the demand for ethanol should follow the same general trend as the demand for other energy products, especially like crude oil and gasoline. However, this intuition is not straightforward because ethanol happens to be both a substitute and a complement for gasoline. This is because when you blend ethanol at 10% with retail gasoline, it displaces, it substitutes away some quantity of the gasoline. So naturally, ethanol is substituting for gasoline in that sense. However, it's also a complement to gasoline because it acts as an oxygenate. And oxygenates are always added to retail gasoline to reduce the carbon monoxide emissions and soot. And it turns out that when retail blenders blend ethanol into retail gasoline, they don't have to add other costly oxygenates like MTBE, which actually was recently outlawed in California and New York anyway. But MTBE is something that is quite costly, and ethanol happens to be a little bit cheaper than that. So they can obtain this oxygenated state by using ethanol. So let's take a look really quick at the chart, at the price series for ethanol and gasoline prices. And here in figure 5, we've got Iowa ethanol spot prices and Los Angeles spot RBOB gasoline prices. And you can see, again, ethanol and gasoline prices are not following each other one for one, but they are generally following the same trend. Alright, so next let's talk about the crush-spread relationship for the ethanol industry. Now this is going to be a really similar discussion as we had for the soybean crushing industry. It's going to be how we are able to follow along with an ethanol plant's or the ethanol industry's profitability. So, as you know, over the last 10 years we saw a really significant expansion in production capacity, and people were following blending margins, or essentially the profitability of a typical ethanol plant, to kind of gauge whether we would see continued expansion or whether we would see expansion slow down. So remember, our no profit argument is if an industry is fairly competitive and they are seeing sustained positive profits, you should expect expansion into that industry. If they're sustaining sustained negative profits or losses, then you would expect some contraction and some plants to actually close down. And it turns out that Iowa State University Extension, they maintain this really awesome Excel spreadsheet model of a typical ethanol plant's profitability. And if you ever go to study the ethanol industry, or you're employed by any kind of firm who's following the ethanol industry, you're probably going to be working a lot with this Excel model. So I've got it linked here, and let's just go ahead and open it up, take a look at it. And here it describes everything about it, and there's a link here to be able to download the Excel spreadsheet. But here it describes a little bit about some assumptions that they make. So they are assuming that their facility was built in 2007. That was when we had a lot of capacity coming online. So there's a whole lot of plants out there that are actually built in 2007. And the production capacity is 100 million gallons. That way we're kind of benchmarked to a certain scale of ethanol plant. And they assume a certain construction cost for the facility and finance costs. And they assume things like the fact that they're going to get 2.8 gallons of ethanol per bushel of corn. We'll see that in our chapter in a little bit. And 1 bushel of corn will produce 18 pounds of distiller's grains. And that it's going to require 34 cubic feet per gallon of ethanol to dry the distiller's dried grains. And then they include typical input costs, which are going to be basically cash prices for corn and cash prices for natural gas. And then they include prices for all the important stuff, which is ethanol, corn, DDGs, and natural gas. And they plot basically revenue, costs, returns, profitability, all kinds of different ways so that you can get a sense for profitability. So I'm going to click this link here, and it's going to open up this Excel file. So if you click here, Overview and Assumptions, you'll see them listed here. And here's the economic model, which if you would like to change any of those assumptions, you can just change the values in this cell. For example, you could say, what if we had a technological breakthrough and we could get 3.2 gallons of ethanol per bushel of corn? Well, that would completely change the economics. And you could say, well, what if that happened? Okay, and they have really detailed assumptions about production's costs, and you'd have to be an engineer or something to know where those costs come from, and I'm not that, so we'll assume they've done a good job figuring those out. And then they have a bunch of tables here of returns per gallon, but the charts are a little more interesting. This one is one that's pretty closely followed by the industry. This one on top plots the ethanol sale price, so this is the actual sale price of ethanol, and the blue line is the price they need to sell ethanol for to break even. So basically, periods when the orange line is above the blue line, ethanol plants are making money. When they're on top of each other, they're basically breaking even. And you can see there were periods of huge profitability in 05, 06, and 07, where they were making as much as $2 a gallon briefly in profit over their operating costs. And there have been short periods of time where they were sustaining pretty decent profits for a fairly long time. Looks like we've stabilized here, and we see the break-even line and the actual price kind of bouncing on top of each other for the last couple of years, which is what you would expect when the industry kind of reaches its equilibrium. So down here they've kind of put this break-even point in terms of the price of corn, because you could either say to yourself, this is the price I have to sell my product, ethanol, for to make money, or this is the price I need to be able to buy my input for, corn. So here the actual price of corn is plotted in orange, and in blue this is the amount they could pay for corn and just break even. So you can see profitability here in just a different way. Briefly here, in the spring of 2006, they could have paid as much as $7 per bushel for corn and still broke even, but really they were only having to pay about $2 a bushel for corn. So that's profitability reflected in a different way. And so you can see the same pattern here. After that early period of huge profits, you can see small periods of profitability where the blue line is above the orange line, and over here in the more mature time of the industry, they're kind of, those actual prices and the break-even prices are bouncing around. Okay, so that Iowa State ethanol plant economic model is a great resource if you're interested in the ethanol market. go back and check it. They keep it updated at least once a month or whenever they get new prices. So you can just follow along what's going on in the industry by periodically visiting that spreadsheet. Alright, so let's talk a little bit more in detail about exactly how you would calculate the ethanol producer's profit and essentially allow us to generate those profit per bushel figures very similar to what's in that economic model. We didn't see that exactly here, but they've got it. I think you call it the grind margin. Yeah. So they've got the ethanol plant's return in dollars per gallon, and they give you here return over total cost, return over variable cost, and return over grind margin. So if you just count the corn and the natural gas, you get the orange line. So that's their kind of gross return in dollars per gallon. But if you also throw in other variable costs, I'm not sure exactly the assumptions here. Maybe natural gas isn't included in the orange line, but corn price is. But anyway, I can see that I remember that return over total cost would be their real profitability. So you can see here in dollars per gallon of ethanol sold, we've got huge profits where the blue line is way above zero, and then it kind of comes down to zero and experiences several significant periods of profitability, and even recently they have had brief periods of decent profits. Okay, back to our book. Let's talk about how you would calculate that. So here is the ethanol producer's profit roughly, except not for fixed costs there. So like any profit equation, you're going to have your revenue minus cost. And in this case, revenue is going to be the price of ethanol times the quantity of ethanol you sell, price of DDGs times the quantity of DDGs that you sell. Those are your two revenue streams. And minus the price of corn times the quantity of corn. This is very similar in feel to our soybean crush example. And as we saw in the Iowa State model, a bushel of corn will yield 2.8 gallons of ethanol, and it'll yield 17 pounds of DDGs. So we can plug in these quantities. If we're producing crushing one bushel of corn and turning it into ethanol, we'll put a 1 here implicitly for the quantity of corn, 2.8 for the quantity of ethanol, and 17 over 2,000 for the quantity of DDG. 17 because we get 17 pound of DDGs for every bushel of corn ground, and divided by 2,000 because DDG prices are usually quoted in dollars per ton, similarly to how soybean meal prices are quoted. So this equation here would give us the gross processing margin per bushel of corn processed into ethanol.